Okay, can you see my screen?
Yes, ma.
All right. Thank you very much for attending once again. I'm going to start the class now. So today we're going to start with interlocking accounts, and further classes will deal with integrated accounts. So before I even go into describing what interlocking or integrated means, those terms mean. Um yeah, so okay, bookkeeping forms the foundation of accounting, right? Financial accounting specifically. So till now we know about how you prepare financial statements in financial accounts. You prepare subsidiary books after collecting information, you prepare subsidiary books, and then you prepare the ledger, you prepare the trial balance to test those balances, and then lastly you go forward to like prepare your financial statements. But then this, like those measures or those practices, that process is not limited to just financial accounting alone. In some companies, big companies specifically, they usually have a cost accountant separate from a financial accountant, right? Or it might be the same person or the same team, but performing different functions. So the cost accountant also has to keep records of things. I mean, ultimately, that stewardship function, the whole reason why you are preparing financial statements is so that you can show it to people, right? And what you are going to show them is what financial accounting produces. But for management reasons, there are just some things that does not really concern, when you want to set prices, you're not really concerned about some things that financial accounting will deal with. So you have to prepare cost accounts that are specific to what you are doing in cost accounting. Do you understand? So when you want to make certain decisions like what you should price your products, or what the best supplier to use, or how efficient you are in production, what you use to make this decision, especially in big companies where they have high level of manufacturing activities, it is better for them to have cost accounts also. So as you can see here, the process is not limited to financial accounting. It extends to cost accounting as well. Both types of data must be properly maintained and processed to generate useful information for decision making. Now, in some cases, they are like the size of your cost account depends on the size of the business. So as I mentioned, it is usually bigger companies that keep separate records. So that leads me to describing or explaining what an interlocking accounting system means. So when you hear interlocking and integrated, when in an integrated system, you integrate cost and financial accounting functions. You integrate those entries, you integrate them. So you prepare one statement for both the cost accountant and the financial accountant. So that means when you want to make decisions related to costing, you go there. When you want to make decisions related to financial accounting, you go there. Do you understand? So in most cases, this one is maintained by smaller companies. However, interlocking accounts, on the other hand, interlocking accounting system involves maintaining separate cost accounts that are reconciled periodically with financial accounts. So in an interlocking system, you prepare your cost accounts separate from your financial accounts. Do you understand? So at the end of the period, of course, obviously, you have different profits. Do you understand? You have different figures, different figures, or different outcomes from both financial and cost accounting account records, because there are certain things that the cost accounts will treat that the financial accounts will not treat. There are certain things that they might both treat them, but then they'll treat them in different ways, maybe in their method of valuations and all. As we go further, we are going to look at those things that will cause differences. But the first thing I want you to take note of is that an integrated system is one where both cost and financial accounts are prepared as one account. They are prepared together. However, in an interlocking system, they are prepared separately. So you have your cost accounts, you have your financial accounts, and then at the end of the period, they are reconciled so that you have one single profit. Do you have any questions so far? Can you all still hear me? Do you have any questions so far?
We can hear you, ma.
All right. So I'll take it you have no questions then. Now, okay. Now, yes, you are already familiar with how to prepare your financial accounts. You start from, as I mentioned, you start from collecting your records, and then you prepare your ledger, and then your trial balance, and all of that. So in cost accounts, it is almost similar actually. It's almost similar. However, like there are fewer entries, because what cost accounts is actually like really concerned with is usually the production point, right? So there's a different process, or there are different double entries that you should know, or you should note when dealing with cost accounts. Your examiner might ask you to prepare a cost ledger account, which is highly uncertain anyway, but just know it. So yeah. So in the interlocking cost system, the cost ledger serves as the principal ledger. It generally contains control accounts for stores, work in progress, finished goods, overhead, and supported by a subsidiary ledger. Basically, what all this is saying, you can see there's mention of things like stores, and stores just means inventories, work in progress, finished goods, overhead. So these are the accounts, these are the ledgers, these are the control accounts that are kept in a cost accounting system. So when you're preparing cost accounts, these are the major things that are prepared. Your raw materials ledger, you have your work in progress control account, you have your production overhead control accounts, wages control accounts. So all these things are the things you prepare when you're doing this one. So a key feature here to know about is the cost ledger control account. Now, in let me ask you this. Let me test your knowledge of financial accounting. This is a question I need you to answer, please. So say this is a financial account. Imagine you're doing financial accounting and you made this transaction. You bought raw materials with cash. How do you record it? What is the double entry for that?
Credit cash and debit raw materials account.
Exactly. Debit raw materials and credit cash. Now, the reason you are doing that way in financial accounts, because financial accounting is concerned with beyond raw materials. It is also concerned with cash, because cash is an asset. You need all of that. You need to take note of all of that for you to have proper accounts to present. However, in your cost accounts, the only thing it's concerned with is raw materials. Where is that raw material? Like, it doesn't really care whether you paid with cash, whether you bought it on credit, your assets, your liabilities. At that point, it is not like what it is concerned with is, I bought raw materials. Do I have enough raw materials to send to work in progress? Do I have enough finished goods to send out for sales? That is what cost accounting system is concerned with. So in this case, that's where a cost ledger contra account comes in. It serves as buffer, or like the what ensures double entry. So in this case now, when you buy raw material under a cost ledger, we're still going to look at all the double entries for different transactions that are important to a costing system. But let me just mention this. So in this case now, when you buy raw material under a costing system, when you want to record it, you debit raw material, but you credit this cost ledger control account, because you don't care whether it came from cash, or you just like that cost ledger control account is the link between the cost accounts and the financial accounts. So it is the financial accounts that will now record it as credit cash, or credit bank, or credit creditors, or whatever. But to the cost accounts, you just debit your raw materials and you credit cost ledger control accounts. If it is reversed, that is the case, or if you maybe you bought finished goods, what you sell is finished goods, or you paid for labor. Yes, if you paid for labor, you debit your labor account, you credit cost ledger control account. So basically, the cost ledger control account is there to like help the movement, to ensure that you are actually practicing double entry under the costing system. Is that clear, or should I take it again?
It is clear, ma.
All right, thank you. Now, another point of focus in the costing system is the work in progress ledger. Now, the whole point of your costing system is to transform your raw materials to finished goods, right? So you want to know how much you incurred while doing all of that. And when you buy raw materials, or like you have to mix it up, or you have to convert it using a lot of things, overheads, labor, other expenses. all those things together, the process, the point at which you are mixing them, that they are not yet finished goods, you call them work in progress. So basically, that work in progress is a very important, like, because every raw material, every labor, every overhead, everything you buy has to pass through it to become a finished good. So it is one of the like central focus in a cost accounting system. Now, and then it depends on the type of organization. In an organization that uses specific order costing, or what we call contract costing, or in a contract costing or batch costing. In this case, sorry, not batch, contracts. In this type of costing or job costing, that's what I was looking for. You know that each product is unique to the customer. So it is a company that usually sells customized products to each customer, right? So for each thing, they are going to have different work in progress accounts like that. So the type of organization depends on or determines how many work in progress accounts you have, or the type of work in progress accounts that you have. Now, upon completion, that means when the work in progress has been completed, when you have combined everything together, your materials, your labor, indirect and direct, when you have combined everything together, they become finished goods. And those things have to leave the work in progress account and be transferred to the finished goods account. So if at the end of the period you still have some things that is left, it becomes work in progress, closing inventory. All these things are things that you've probably heard before. So let's look at the double entries under the interlocking system. So look at what I explained initially. I said when you buy raw materials, you debit raw materials account and you credit cost ledger control account. That cost ledger control account, as I mentioned, is what ensures double entry in the costing system. So in a costing system, you are not concerned with all those outside things that don't really affect production in itself. What you are interested in is this raw material in this transaction. However, it needs to be a double entry. So you have debited raw material because yes, you're supposed to debit an asset when it increases. But where would the credit go to? Just take it to cost ledger control account. Then when you return some of those materials are returned to the suppliers, obviously you reverse the transaction, right? You debit the cost ledger control account and you credit raw materials account to reduce it. Now, when you issue these raw materials to factory, you send them to factory. Now, I hope you know that materials are both direct and indirect, right? There's direct materials, and then there are materials that form part of overheads. Now, let's assume that you have a fashion designing business, right? The fabric that you're actually using, that you're trying to convert to a cloth, that fabric is your direct raw material. Maybe the zip or the flowers that you use to decorate it could be added to that. But then you have things like the lining, you have things that inside that, like, not many people will see. You even have things like maybe the lubricants for the machine that you are using to make that dress. So all those things are also materials, but they form part of overheads because they are indirect. Another name for indirect expenses is overheads. So when you are issuing materials, your question will tell you, or you'll be told, what kind of materials are you issuing, right? Are you issuing direct materials? If you're issuing direct materials, you debit work in progress account straight. If you are issuing any other type of material that's supposed to be overhead, you debit production overhead control account. When we solve a question, you understand this better. Then, okay, now looking at this, if you are issuing raw materials, it means you are taking out of, you've already, when you bought the materials, you already put them in the raw materials account. So when you want to issue them to somewhere else, you want to give them to another account, what you are doing here is you are reducing it, you are removing it, and to remove it, you have to credit raw materials account and you increase where you are taking it to. So either it is work in progress or it is production overhead. The corresponding entry for raw materials account is to credit it. Then for wages control account, for wages that you incur, maybe you paid wages. Yes, you paid wages to factory workers, just like you treated raw materials also. You debit wages control account and you credit the cost ledger control account. Now, for wages allocated, just like your raw materials, you also issue, you also saying, like, after, let's say for instance, you hire factory workers to come and work for you. After hiring them, you have to assign them to certain places that they work. So are they working directly with how the good, like where the goods are being produced? Like, are they direct to the production process, or are they just there to service? Are they there acting as things like supervisors, people that are not really contributing directly to that product? So if they are indirect workers, if they are indirect labor workers, you send them to production, you assign that to production overhead. But if they are direct, you you debit work in progress account, and of course the corresponding entry would be to credit your wages control account. Now, okay, you remember we when you assigned materials to production overhead control account, you debited it. When you assigned wages, you debited it. So all this now will make your total overhead, and your production process is not complete without your overheads. Actually, you have to assign overheads to them. So initially we're only sending the direct ones, the direct expenses, to your work in progress control account. When you are now done, like, collating all your indirect expenses, you now charge everything to your based on what you've been asked to charge. You absorb. Yes, you call it absorb. You absorb it, or you charge it to the production process by sending it to work in progress account. So you debit work in progress control account, and you credit your overhead control account. Now, at the end of it all, as I mentioned earlier, when you are done, your product is your finished goods. So you send finished goods, you debit finished goods to send it, and you credit the work in progress control account. Do you have any questions so far before we take a question?
No, ma'am.
Okay, just give me a second. I'm going to send the question to the group chat now, and we'll try to solve it. Okay, can you see my screen?
Yes, ma'am.
Yes, ma'am.
Okay, and I sent the question to the group chat. Have you seen it?
Yes, ma'am.
Okay. I'm so sorry I could not send the question earlier for you to print it. I was having some troubles. Okay. So increase the font. Okay. Assuming we can all
Please, ma, I can't
discuss.
hear you well.
Okay, I said I'm assuming we have all gotten the question right.
Please,
Yes,
ma,
ma'am.
can you please speak up? The voice is not that loud. I don't know, maybe it's from my end.
Yeah, maybe it is from you. And can anybody else hear me faintly, or is my volume okay?
I can hear you clearly, ma'am.
Okay.
Yeah, your
Please.
volume is okay.
All right. Thank you. So I'm going to be starting with ABC manufacturing. Now, ABC Manufacturing operates an interlocking cost accounting system. The following transactions occurred during the period. Opening inventory of okay, you have opening inventory, raw material, 60K, work in progress, 70K, and finished goods, 30,000. Raw materials purchased, 500,000. Materials returned to suppliers, 50,000. Materials issued, working direct materials was 400,000 and indirect materials were 80,000. Wages incurred 300,000. Wages allocated, direct wages 200,000, indirect allocated to factory 100,000. Closing balance of work in progress was 100,000. So we are required to prepare the relevant ledger accounts based on the interlocking system and extract a trial balance from these accounts at the end of the period. Now, if you are given a question like this, or if you see something like this, it is actually good for you if you're asked to prepare a trial balance, because even if you're not asked to prepare a trial balance, you might just try to do it, because that would show you whether you are correct or not. Well, in most cases anyway, if you make a mistake that you should I say balance out with another mistake, it might end up balancing and you think you did the right thing. But in most cases, it is good if you have to prepare a trial balance. So let's get into it. So we have been asked to prepare the relevant ledger accounts. Okay, can anybody attempt or just give me your guesses? What do you think are the accounts we have to prepare?
Raw materials account.
Yes. Okay.
Work in
Let's go.
progress account.
Material.
Work in progress account.
Post ledger control account.
Okay.
Production something.
Production something.
Oh, you want to write something?
Right.
Unfinished goods control account.
Yes. Hey, what did I write like this? Okay. Now let's try to prepare this. So let's start with let's just open everything now and then just make our entries as we could. So let's see. This is going to be a lot of tables. So we are doing 5 different tables. There's 2 times 5. 3. Okay. I think we have everything now. So, okay, never mind. Copies. Just call it that. Let's call this one. Did we make listen for wages? No, we did not talk about wages. Yeah, to create for wages also. Wages account, then production overhead account, then work in progress, then this be finished goods. Let our cost ledger control account come last. Okay. Should include it here. Okay, so from the first, what is the first thing we are told? We have is anybody still with me?
Yes, ma'am.
Yes, ma'am.
So we have opening inventory, raw material, 60,000, right? So let's call it balance forward. That'll be 60,000. Right. Okay. Then work in progress. Forward. 70,000. And then finished goods. 30,000. Okay. Now, if these are here, this should also have them. And I need to create this one. Okay. So since those are anyway, you say opening inventory. Opening raw materials. How much? 60K. Have opening.
Work in progress.
Yes. So you just
70K.
exactly 70,000.
Finished goods 30K. Oh, we're not okay.
Open goods 30,000.
30K.
Good. Now, what's the next thing? So we are told that we
Raw
purchase raw
raw
materials.
materials.
Yes. So what's the double entry for that?
Debit raw materials account and credit cost ledger control account.
Exactly. So let me say cost ledger. Let's put cost ledger. How much was it? 500,000.
500,000.
So you're crediting this place. Serious. Good. Pardon my table. Okay. Then the next entry, the materials returned to supplier. So we have to reverse the transaction, right?
Yes,
So
ma'am.
50,000. Yes, so credit raw material, say cost ledger,
Debit ledger.
50,000. Okay, next entry. Materials issued to two places. So the first place, they said we issued materials to work in progress, right? Okay, so what do? You first debit, you first credit your raw materials because you are taking it from there. How much raw materials? 400,000, right?
100,000.
You say WIP. Let's put on 400,000, and then you come to work in progress account, debit it. Say raw material. That'd be 400,000. Sorry. Then you have to treat the second one. So where is that second one going to now? Indirect materials. Where are you taking it to?
Production overhead.
Yes. It's a production. 80,000. This is the preparation is basically just your normal double entry. Just have to know which account everything is going to. So you come to production overhead account and you debit it the raw material. 80,000. Now next, wages incurred 300,000. What is the entry for this one? You paid for labor. What is the entry for this one?
Debit wages account
Okay.
and credit
Cost ledger.
Okay, thank you. Cost ledger. How much? 300,000.
300,000.
Okay. Sentence. Yeah. Now, next in wages allocated. So direct wages, how much? Direct wages 200,000.
200K.
200,000.
WIP 200K. Come to work in progress.
Work in progress. Debit work in progress. Okay.
The wages there. And then now come here again. They said they also gave to factory, so production overhead, right?
Yes, ma'am.
100,000. So it comes production overhead account, and you say wages. 100,000. And we were told that the closing inventory of work in progress was 100,000. So what they are trying to say is, here's our work in progress account. After receiving all of this, at the end of the period, we were still working on some things, right? At the end of the period, we still had, at the beginning, we had 70,000 work in progress. And at the end, they're telling us that we had a balance of 100,000. So this would mean that if you add up everything here, what does it give you?
670,000.
70,000. Okay. 670,000. So if you have 670,000, everything you received during the year plus what you had at the beginning was 670, and at the end you still have 100. What does that mean? Like, it means how much did you give out? How much did you transfer to finished goods during the year?
570,000.
570.
Yeah. Exactly, 570,000. So you come here, you say work in progress. Times 70,000. Okay. And so this one, now, normally this one is supposed to keep on going. It's supposed to continue. That's your finished goods. You're supposed to also take your finished goods. You have to transfer it to, if you are preparing your profit or loss statement, you now take it to cost of sales. So you credit it with profit or loss. But we're not going all that way. We are stopping at trial balance. So you just end it here as if your finished goods account is where they ended. So you come here, you close this account. So your balance carried down. How much is this?
600.
100,000.
No.
Yeah.
No, Joe. Me that have cough.
$600,000. And then the closing here is 670. You have to close everything. So what would, okay, I'm sorry, we are not yet done. We can't close this one. We can't close them yet. So sorry. So sorry. There is an omission in the question. Okay. Not yet. Okay. So let's come back to our work in progress accounts. There is one more thing that needs to be entered here. So there is an omission in the question, but we are supposed to be told what to do with the production overhead, right? I'm going to edit the question and send it to you. But yeah, we are supposed to transfer our overheads. We are supposed to absorb, yes, that's the language. You're supposed to absorb overheads into your finished good, because as I mentioned, it takes more than just your direct materials and direct labor to make a complete finished good. It takes more than that to make a complete commodity. So you need all your indirect labor, indirect materials, all work together to make it. So you have to absorb overhead into your production process. So at the end of the period, as we talked about this when we are going over the relevant entries, you're supposed to transfer this to your work in progress. So you credit it to take it out, depending on. I think the question said, "Oh, absorb 150,000." You have a closing balance here or something, but in the question was supposed to say you should absorb everything, no under or over absorption. You take the entire 180,000 to your work in progress. That's that. So you credit this with the overhead, and so this one will close itself, and then you come here.
Okay, ma, that means our production overhead will later go to work in progress.
Yes, it will later go to work in progress. Yes, it will later go there. I mean, they are your indirect expenses, so they are still part of the production process. Production needs prime cost and overhead. So the ones we brought there initially, from direct raw materials and direct labor, will be a prime cost. This is your overhead. So add 180,000 to this was 670,000. How much would that be?
850.
What did you say?
850,000.
850,000. Okay. Yes. So 850,000 closing. So this is going to be 70,000, right?
750.
750, sorry. 750,000. Okay, so you can now come and close this. You say 850, sorry, 750. So the closing will be 780. Okay. That closes that. Then this balances itself out. They are both 180,000. This one also closes itself. They are both 300,000. For this one, do we have a closing balance for raw material? Let's calculate and see. Is there a closing balance for raw materials? Are we calculating?
Yes.
What is the closing balance?
30,000.
30. Okay. So everything will be 560,000, right?
Yes, sir.
Okay, so we've closed this. This one balances itself. This one balances itself. We've closed this. We've closed this. Now let us close this. So what will be the balance here?
910.
910.
910.
Yes,
Okay.
ma'am.
Wait, how did you arrive at 910? Sorry. This is 60, this is 130, 160, 660, 860. You're supposed to subtract 50,000 from it.
Mine is 960.
Oh, it's 9?
960, yes.
Yes.
Yeah, sorry. So sorry about that. Okay. Okay. And 60,000. Okay. Now, what does the second part of the question say?
Extract a trial balance from this account at the end of the period.
Okay. So let's extract our trial balance. Okay. So here you have debit, credit, behind the entries. So all those that had where are the ones that had closing balances? So we have a closing balance in raw material account. It is an asset 30,000, right? So bring it here. 30,000. Then which other one had a closing balance? Wages, no. Production, no. Work in progress, yes, 100,000. Then what about finished goods? Finished goods 750,000. That's supposed to be equal. Okay, yes.
Oh, we are picking their balance CDs only.
Yes. Yes. That's their closing balance. It's their closing balance. How much do you have left that you have to use to prepare? 750,000. And then your cost ledger. Where is this 10,000 coming from? It's 20,000. How much is our closing? What's the addition of this? 780.
880.
850. There is
608.
There is a mistake somewhere. This one's supposed to be 3,500.
Ma, are we not going to take the production this thing again?
No, there is no closing balance there. So it is not supposed to. Trying to figure out where this closing balance came. Oh my god. Oh, it's it was not supposed to be. Give me a second. I need to recheck this question.
Yeah, fine, sir. I'm good.
Okay, so we made a mistake here. We did not calculate. What is this? This is 7. Our balance carry down here is supposed to be 780, not 750. Okay. So this is supposed to be 780. Okay.
There's still a difference of 50,000.
Yes, there will still be a difference of 50,000. Give me a
Our balance CD for cost ledger is 910, not 916.
Thank you very much. So are they the same now?
Yes, ma'am.
Thank you very much for noticing that. And then this is also 19. Oh, but okay. Yes, so we are done with that question. Do you have any questions before we proceed? I'm going to assume you have no questions if I don't get any response. Do you have any questions? Okay, no questions then. Okay, can you see my screen?
Yes, ma.
Yes,
All
ma'am.
right.
Yes, ma'am.
So now that is about preparing cost accounts. So as I mentioned earlier, after preparing your trial balance, that was just a trial balance extract anyway. A normal trial balance will have other information for you to prepare your statements. So after using that information to prepare your statements, you get a profit naturally, right? However, the financial accountant is also preparing his, right? So at the end of the period, you have to reconcile the profits. Do you have the same profits from cost and financial accounts? If not, what causes this? So let's look at these things that might cause differences in financial accounting profits and cost accounting profits. So in interlocking systems, the profits shown in costing profits and loss accounts may differ from that in the financial profit and loss account, making reconciliation essential. So these differences may arise from different things. Firstly, appropriation of profits. By appropriation, we mean sharing of profits. So normally when you prepare your statement of profit or loss under financial accounting, out of that profit you pay dividend. If it is a group of companies, you probably pay parent company a certain amount, you share the profits. If you have to pay tax, you also give government its own share of the profits. And then it is like you probably send some part of the profits to reserves or something. So it is whatever is left that you report as your net profit. However, in cost accounts, in most cases, cost accountants don't do all of that. They are not concerned with how much tax they have to pay. They are not concerned with sending to reserves. They are not concerned with paying dividends to shareholders, right? So it is things like this that might cause one of the things that might cause a difference in the profits. And then another thing is charitable donations. So for donations are usually concerned with financial accounts. So it's in financial accounting that they are usually written off as expenses. But in cost accountants may not even be aware of such donations because all they are doing is trying to ascertain costs. Then okay, there you have it, depreciation of buildings, plants, and similar assets, as well as bad debts, even things like bad debts or goodwill. You are writing off goodwill, or you are paying for you know um, preliminary expenses before, expenses that were incurred before the company came into, like, a lot of things might might come as charges on your profits, or that you might have to appropriate your profit to different places. So all these things are usually concerned with financial accounts and all the IFRS standards. So according to those standards, yeah, but in cost accounts, you don't necessarily have to follow all these standards. So in most cases, these costs are not charged under cost accounting, and it causes a huge difference in both profits. Now, another thing that causes a difference in both profits are financial matters that fall outside the scope of accounts. So just like those appropriations that we talk about, there are also some incomes that the cost accountant knows nothing of. The only income that the cost accountant is concerned with is probably sales, right? So it's trying to know, okay, should I increase? Should we, cost accountants make decisions like, should we increase the price? Should we increase number of units? They are usually concerned with just sales. However, in financial accounting, they deal with other incomes like interest received from bank deposits, investments, rent receivable if if the company lets out part of its buildings, right? So all these are excluded from the incomes that come into cost account. So it also causes a difference in in the profits. In addition to that, you also have profit or loss on sale of investments, assets, and other things. So in most cases, when assets are sold out, it is usually accounted for under financial accounting. It is not, they're usually ignored in cost records, right? If there are penalties that they have to pay by law, probably for breach of contract, or they are fined by the government for an offense, it's usually financial accounting that deals with all of this. So all of these have to be reconciled in the cost account because the profits obviously going to be overstated or understated from these things that were omitted. Now, another set of items are items that are treated differently in cost and financial accounting. So they are usually like, take for instance, the recording inventory. So they are both treated under financial and cost accounting. But in financial accounting is strictly following IFRS standards. So you do not record something higher than its value. So in most cases, it's usually recorded in probably, yeah, there's its realizable value, right? Higher of realizable value or cost to sell. So you look at all of that, you value all of that when you're using financial accounts. But in cost accounts, they usually just, how much did I buy it? How much am I selling it? Like, they do not do all those valuations that are required and mandated under financial accounting. So at the end of the day, even inventories that were recorded under both accounts may be recorded differently. And when you overstate or understate your closing, opening inventories of different things, they usually understate or overstate the profit. So we're going to look at how each of them um affect them. We're going to do a question. We're going to take a question now. But before we do that, I need you to bring out your pen and your paper because I'm going to be writing out, or I'm going to be listing out the treatment of certain things. Are we writing?
Ma, please, can you come again?
Okay, I need you to be with your pen and your papers, or pen and books, or pencils, whatever you use to write. I need you to take this down.
Ma'am.
Yes. Are you there?
Yes, ma'am.
Okay.
Yes, ma'am.
So now you can, in a question, you might be given your financial accounting profit and be asked to reconcile it and show the cost accounting profit. Sometimes you might be given the two and be asked to start with financial accounting profit, adjust it, and you end up with your cost accounting profit, which they would have given you. Sometimes they will not give you, they'll just say you should find it, and whatever you find, you just hope that it is the right thing. And then in other cases, you'll be given your cost accounting profit, and they'll tell you things that happened in financial accounts that you have to adjust your cost accounting profit for, and then find your financial accounting profit. So now we are going to assume that we are starting with financial accounting profit. So I need you to write this down. You say adjustment, right? So format for adjusting, or just say adjustment of financial accounting profit to ascertain cost accounting profit. I'm sorry, I know I'm usually too fast. Let me take that again. Ascertainment of cost accounting profit starting from financial accounting profit. Are we there?
Yes, ma'am.
Yes, ma'am.
So the first thing, let me give you all the things you will add. So you say profit as per financial accounting. Say profit as per financial accounting. Of that. So the things you add. Now I'm going to explain it and then I'll tell you why we are adding it. Or I'm going to give it to you and I'll tell you why we're adding it. So the first thing you add, if you're starting with profit as per financial accounting, you first add increase in opening inventory. Increase in opening inventory. Do you have that down?
Yes, ma'am.
Yes, ma'am.
Increase in opening inventory. Now, let me explain why you are adding an increase in opening inventory. You know, when you're calculating your cost of goods sold, you say opening inventory, right? You now add your purchases. Am I right? Please correct me if I'm wrong.
Yes.
You now add that, and then you deduct your closing inventory, right? And you have your cost of goods sold. Now, if your cost of goods sold is supposed to be, I think this will be better if we have a visual. So let me try to give you a visual of it. Give me a second. It would be better if we had a visual. Sorry, just give me like 5 moments. I'm trying to load it and put my screen. Can you see my screen, please?
Yes, ma'am.
Yes, ma.
Yes, ma'am.
Okay, so what I was explaining, if you are trying to calculate cost of sales, you usually say, let's just give me figures. Opening inventory.
$5,000.
What did you say? How much?
5,000.
5,000. Okay. Then give me purchases. How much should we use for purchases?
3,000.
Hmm?
3,000.
3,000.
You want your purchase to be less? Okay, 3,000. No problem. Okay, closing inventory now.
2,000.
To go to class, she might manage class. There's this Bible. One shape. Yeah, but not like too much.
Can you mute your mic?
Down. So I was thinking.
Thank you. Okay, so how much will this be?
6,000.
On 6,000, right? Good.
Yes, ma.
Now, by increase in okay, this is our cost of goods, so cost of sales. Now, so that means for your profit is your sales minus your cost of sales, right?
Yes, ma.
So let us assume here that our sales was 12,000. So our profit is going to be 12,000 minus 6,000, right? And that will be 6,000. Now, imagine you overstated by increasing opening inventory. What they mean, or what I mean is, if your financial account, you're starting with profit as per financial accounting, right?
Yes.
So if your financial accounting profits under your financial accounting, if the opening inventory was higher than the one used in cost accounting, that means the way it is 5,000 here, let's say it was 3,000 under cost accounting. Do you understand? That's what it means. Do you get? So this what I'm trying to explain here is this. Now you know that your profit is supposed to be 6,000. If,
Yes.
say for instance, you overstated your opening inventory, it was supposed to be 3,000, or cost accounting used 3,000. What would this mean? This will mean that your cost of sales will change to what? 4,000, right? And this will change to 8,000. So what I'm trying to share is your profit has increased. Right? Because before you overstated your opening inventory. So it means that if in a question or in like a given situation, your financial account under financial accounting, the opening inventory was higher than the one in cost accounting, and you want to adjust that profit, you have to add back that difference. So you're going to be adding that 2,000 naira difference. It was 5,000 we put there before instead of 3,000 that cost accounting used. So if you want to adjust it, you're going to add back that 2,000 to the profit as per financial accounting, so that you will get your normal profit as, because by overstating our opening inventory initially with 5,000, we decreased the profit we were supposed to have. So you have to add it back. You have to add back that difference. Do you understand?
No, ma. Kind of confusing.
Okay. Let me take it again. So you get what we are starting from profit, as we are trying to adjust. You get what we're trying to do? We are trying to adjust our financial accounting profit to make sure it is the same as our cost accounting profit, right?
Yes, ma.
Okay. Now, when we were preparing our statement, to get your profit, you probably went through a long journey. But we are going to limit that journey to just this 1, 2, 3, 4 calculations that we did here. You understand? So now, what I'm saying is, if in your question or in the situation you are given, when you were preparing under the financial accounting statement or under financial accounting, the opening inventory was overstated. That means it was higher than the one in cost accounting. It means there was an increase in opening inventory. Now, the reason I just wanted to explain why we are adding that increase. The reason why we are adding it is because an increase in opening inventory will understate your profits. If we increase this, like this, the normal opening inventory we are supposed to use is 3,000. If you increase it to 4,000, what would happen? Your cost of sales would do what? It would increase, right? To increase to 5. And if this increases to 5, what will happen to your profits? Your profits will reduce.
Okay.
Are you saying what I'm doing there?
Yes, ma'am.
So do you understand where I'm coming from? Like, oh, sorry, what I'm doing. This should be 5 and this should be 7. Like the higher your opening inventory, the lower your profits. Yes, let me just say that. So the higher your opening inventory, the lower your profits. If you overstate your opening inventory, your profit will be lower. So to correct it, you have to remove that addition that you put on it. So if your opening inventory was supposed to be 10,000 and you charged it as 12,000 instead, it means your profit will be short by 2,000. So you have to add that 2,000 back to your profits. Am I making sense, or is it still confusing?
Please explain. Please come again. That last phrase that you said after, if your opening inventory is big, your profit will be small.
Yes. So the higher your opening inventory, the lower your profit. The higher your opening inventory, the lower your profit. It is as simple as that. If your opening inventory is standard, supposed to be 100,000, and you recorded 150,000, it means that your profit will be short by that 50,000 extra that you added to your opening inventory.
Also, we'll now add that shortage back to the profit.
Exactly. You add the shortage back to your profit. That is it. So that's what we mean by add back increase in opening inventory.
Thank you, ma'am.
So you can just get the format down. When we solve question, you will understand better. But I'll still try to explain each of the entries as we go. So that's the first thing. So if you are adding back increase in opening inventory, what will be your guess for what we'll do to increase in closing inventory?
Say again, ma.
We are adding, you say add back increase in opening inventory.
Yes, ma'am.
What about increase in closing inventory?
We'll decrease it, reduce it.
Yes, you deduct it. Deduct that one. So, but for now, we are talking about what we are going to add. So you add back increase in opening inventory, 1. The second thing you add is your decrease in closing inventory. Decrease in closing inventory. Now let me go over that again. Are you with me?
Yes.
Now, looking at this, say this is what we have in our financial accounting statement. Our closing inventory here was 2,000, but in the cost accounting statement, the closing inventory was actually 4,000. No, let's say 3,000. Closing inventory was actually 3,000. So that means you see that we decreased it here. We reduced our closing inventory here. So if you change this to 3, this is going to become 4. This will be 4, and our profits will increase. So remember I said the higher your opening inventory, the lower your profits. Reverse is the case for closing inventory. The lower your closing inventory, the lower your profits. The lower your closing inventory. So if you reduce your closing inventory, your profits will also reduce. If your closing inventory is supposed to be 100,000 and you posted 50,000, you have reduced your profits by 50,000. So you have to add back that 50,000. Just think of it the opposite way. The opposite is always the case for opening and closing inventory. Are you with me?
Yes.
All right. Now, I'm just going to put this now in entirety. increase in expenses. Increase in expenses. Just say increase in expenses. You add back. We are still under what we are adding. Profit as per financial accounts. What we are adding to it. So we've said we are going to add back increase in opening inventory, decrease in closing inventory. Now I'm saying increase in expenses because obviously this one is even straightforward. If you increase your expense, you are reducing your profits,
Yeah.
right? That one is as simple as that. So that means if you increase your you have to add back those expenses that okay, no, I was not supposed to deduct this, or this was not deducted in cost accounting. So that's what made my profit lower. So you have to put that back, add back increase in expenses. Then you also add back expenses recorded in financial accounts, not recorded in cost accounts. And in most cases, you will rarely see an expense that was recorded in cost account that was not recorded in financial account. But like all the expenses are usually under financial accounting. But you hardly see any expense that it is specifically for that the cost accountants recorded that financial accountants will not record. But there are a lot of things that the financial accountants will put down that the cost accountants will not remember. So just put it there that you have to add back expenses that were charged to financial accounts, but were not charged to cost accounts. So now this one is different from increases in expense. Under there might be expenses like, for instance, there might be things like depreciation of plant and machinery. Plant and machinery is something that is used in the factory. So the cost accountant will probably take note of it, but it will not take note of things like depreciation of office equipment or depreciation of motor vehicle or selling expenses. You'll not take note of all those, right? So there might be expenses that are common to both of them, but then they will record different things. That's what that first one is for. However, for this second one, we are talking about expenses that were not recorded at all in the cost accounts because the cost accountant did not even know about them or did not take note of them. So you add them back.
Sorry, ma, this one you said, is it the same thing as expenses recorded in financial accounts and not cost accounts?
Yes.
Okay, thank you, mom.
Now, lastly, you have appropriation of profits. Appropriation of profits. You add this part of things you also add. This last thing you add, appropriation of profits. So these ones are things like dividend, like corporate tax, like let me see what else. Okay, transfer to reserves, all those things. Those things that bite out of profits in financial accounting that doesn't happen in cost accounting. You add them back. Are we there?
Yes.
Okay.
Yes, ma'am.
Now let's talk about the things you deduct. Still under when you start from profit as per financial accounting. For your first assignment or one of this might be the only assignment I'll give you actually. You are going to prepare your own format. Right? You're going to
Yes.
or I'll send a question later actually for you to solve. But for now, I need you to prepare your own format. You're going to prepare a format starting with profit as per cost accounting. I need you to, it is going to be reverse of what you do in financial accounting. So I just want to see what you do. Now, the things you deduct, still under this one.
You had it under cost accounting.
What do you say?
No, nothing, ma'am.
Okay. So, those first two things we talked about, add increase in opening inventory. What will you do to decrease in opening inventory?
Sorry, ma'am, please come again.
Yeah, when what was the first thing I said you add?
Increase in opening inventory.
So what automatically what will you do to decrease in opening inventory?
You deduct it.
So that should be the first thing under things that you deduct. Decrease in opening inventory.
Decrease in opening inventory.
Decrease in opening.
Please, ma, what did you say, ma?
The first thing you will deduct is decrease in opening inventory, if there is any decrease in opening. You might not have the two there. You might either have an increase or decrease. So if it's an increase, you add it. If it's a decrease, you deduct it. The decrease in opening inventory. Okay, have we noted that down?
Yes, sir.
Okay, so who can guess what the next one will be?
Increase.
Increase in closing inventory.
Exactly. Yes. Now the next one is going to be obviously decrease in expenses. Decrease in expenses. Decrease in expenses. And then after that, you now deduct incomes not recorded in cost accounting or cost accounts. Incomes not recorded in cost accounts. So in when we are adding, you added back all the expenses that were not recorded, but when you are deducting, you deduct all the incomes. So things like discounts received, like rent received, they probably would not have charged it to cost accounts. So you deduct it from cost account, from your financial account. And then that is it. So that is your format. Now, after doing all of this, you get your profit as per cost account. The balance after adding and deducting all of this. You started with profit as per financial account. So when you add all these and you deduct what you're supposed to deduct, you get your profit as per cost account.
Okay, so after adding and deducting the profit,
I can hear you. What are you saying? Now, okay. I've sent the second question. Have you all seen it?
Yes, ma'am.
Okay. Master Limited. Coming.
ma'am,
No, I'm coming. We are going to solve it now. Okay, can you still hear me?
Yes, ma'am.
All right. Now, okay. So this question, we are giving the financial accounts and we're giving cost accounts. And we are required to, what we are going to do here is reconcile the profit in the financial accounts with the cost account and calculate the cost accounting period. So now here, we are not told the profit as per cost account. We're only giving the things that were treated there. So they only treated raw materials, work in progress, and finished goods in cost account. However, in financial accounts, you can see that a lot of things were treated there, and we have our profits. So, as per from our format, what are we writing first? I need you to guide me here. So, what's the first thing we are starting with?
Profit as per financial statement. Financial
Yes.
account.
Yes. How much is that? How much is it?
17,500.
Yes. Now, okay, I think, sorry, I don't know. A table will be better for this.
My God.
Sorry. Okay. Now, look at our opening inventory of now we have 3 types of inventory. So for each of the inventory, different types of inventory, it is the same type of treatment. Add increase in opening inventory. It is the same treatment. Don't think that the one for raw materials is different from work in progress, different from finished goods. It is the same treatment for all types of inventory. Now, do we have an increase? Let's look at raw materials first. Only raw materials. Do we have an increase or decrease in opening inventory?
Increase.
Increase, yes, thank you. So increase in opening inventory. Let's just call it opening raw materials. And that is, how much is the increase?
1,000 naira.
Yes. Then look at it again. Do we have an increase or decrease in closing inventory of raw materials?
Increase.
Increase. So are we adding that or deducting it?
We're deducting it.
Okay, so let's leave that
Yes.
for let's leave that
Who
for
is
now.
that?
Now, work in progress. Do we have an
Open the
increase
door.
or decrease in opening inventory?
Decrease.
Open
Decrease.
the door.
Ma,
Danny.
please, I'm lost to the 1,000 naira. I don't know how.
Okay, we said from the format, you add increase in opening inventory, right? So looking at raw materials, there is an increase in opening inventory because financial accounts had 34,000, while cost accounts had 33,000. So the difference is 1,000. That's the increase. Are you with me?
Okay. Okay.
Yeah.
34,000 minus 33,000.
Yes, that's the increase. So we also looked at closing inventory of raw materials, but here there is an increase and we deduct increase of closing inventory. So that's why we left it for now. We'll come back and decrease it later and deduct it, sorry. Now, work in progress, we have a decrease in opening inventory, right? 7,000 and 8,000. So for this one, we're also deducting it. So you leave it. Then what about closing inventory of work in progress? Is it an increase or a decrease?
A decrease too.
So are we adding or deducting?
We're adding.
Okay. So am I spelling what? Closing inventory.
2,000.
Yes. 2,000. Then what about finished goods? Increase or decrease in opening inventory?
Decrease.
Okay, so we are not adding that. Then what about closing inventory?
It's the same thing.
Okay, so nothing there. We're not treating that. Now, do we have, look at the expenses or the items under, are there any expenses that we are charged to financial accounts, but we're not charged to profit cost accounts?
Yes.
What are they?
Discount allowed.
Okay, discount allowed. Yes. What else?
And debenture interest.
Yes, thank you very much. Venture interest. So
Ma, what about the interest received?
interest received, check your format. What we usually deduct incomes that were not recorded. So interest received is an income.
Okay.
It's an income. It is not an expense.
Okay, yes.
Right now. Debenture interest and discount allowed. How much is discount allowed? 2,000.
1,000.
Okay. Now, let us deduct. So what are the things we are supposed to deduct?
Decrease in opening inventory.
Thank you. Opening. Is it raw material? Yes.
No. Work in progress.
Decrease in opening inventory. Oh,
Work
okay.
in progress.
Okay, thank you. How much is it?
1,000.
1,000.
Decrease in opening inventory again. Finished goods.
Okay.
Yes. 1,000.
1,000.
Okay.
Then increase in closing inventory. Do we have?
Yes. Raw material.
Oh
Increase in close.
yes.
How much was that one?
1,500.
5.
Okay. Is that all?
No.
No. Yes.
What else? That's all.
Yes.
Okay.
And
Okay. So incoming. So what else are we supposed to deduct?
Income in FA, not in cost accounting.
Okay.
Yes.
So what are the incomes we have here?
Interest received, discount received.
How much is the interest received? 750. Discount received. Okay. So, and that will lead us to our profit as per cost account. What's the answer here? So what will be our profit as per cost account? What do you say?
22,250.
22,250.
250.
Thank you. So that is it. It is as okay. Okay. So that is everything for the question. Actually, that's all we are asked to do to find the profits and reconcile. So we have reconciled. Now, for this our question, or for this question that we just solved, we were not given the profit as per cost. In some questions, you'll be told that your profit as per cost account was this. So you'll be able to check if you made a mistake or not. So the type of assignment I'll send to you later this week or by tomorrow, hopefully, would give you, you already have your profit as per cost account. So when you start reconciling from your profit as per financial accounts, you know you are working towards that in mind, and then you know whether you are correct or not, or whether you have to go back and check something. Is that fine?
Yes, ma'am.
All right.
Ma,
So
this
we have,
profit as per cost account, is it the addition of all of this?
yes, it is the addition of everything. So you added all those ones up, and then you deducted the ones under to get it.
Please, ma, I have a question, ma.
What's your question, please?
Yes, ma, please, can you explain how debenture interest is an expense?
Oh, debenture means debt. So when you take a loan or you borrow from certain people, debentures are treated like they are just like shareholders, right? They also give you their money, but for shareholders, what they expect to receive is dividends. So if the company doesn't make profits, they receive their own returns after profit is calculated. If the company doesn't make profits, they are not receiving anything. However, for debenture holders, they are usually treated like they are basically your creditors or people that loaned you money. So whether you made a profit or not, you have to pay them an interest. So it is an expense. It's just basically your
Yes,
interest
thank
on
you, ma.
or interest on loan, something like that. Okay. Do we have any other questions?
All right, ma. Okay, ma.
Ma, I have a question, but it's not relating to what.
Okay.
Okay, ma, is it that till our exam, the classes will be just Saturday and Sunday?
Yes, I mean that is the timetable.
Okay.
Yeah, that is good. But let me see. Once we start revision, I cannot guarantee classes. But what I can guarantee is one-on-one responses when you have a question at any time of the week.
Okay.
Probably during your private reading, you have something you need me to clarify, I will do so immediately.
Okay. Thank you.
Yeah, you're welcome. Okay, I think I'll stop recording the class now. Do you have any more questions before? So next week we're going to treat integrated accounts. That means where financial and cost accounts are treated